if 70% of your wealth is in the stock market, and it is a 2.3 standard deviation of being in an asset bubble and priced to perfection, and we don't have 20% growth over the next 5 years annualized, if the market corrects, 70% of households that have wealth in the equities market could come crashing down. They could lose a lot. And the thing is, Michael, it might not ever come back because the price they paid, if they paid these top dollar prices, is so high. It could take a decade for those prices to get better. And you look at Amazon, years ago when the bubble popped, I mean, they were like worth almost nothing. Now they came back, but it took 10, 15 years for them to do so.
All righty, folks, we are going to talk tariffs. We are going to talk about Paul Tudor Jones warning that the stock market or equities market is richly valued. And we will talk about 2 folks over 50 getting healthy. We're going to have this conversation with Anna REI mom, Kelly. How you doing?
Hey, now, I'm not over 50 yet.
Oh, you are
50.
You are 50.
I'm already having a hard enough time admitting that I'm 50. So don't push me over 50, Michael.
My mistake. I stand corrected.
I'm just teasing.
I know you are. Well, we will hit these 3 topics. Why don't we hit tariffs first? Obviously, there was a big rigmarole over Mexico and Canada the last 48 to 72 hours. There's obviously tariffs now in effect with China and China reciprocating. Tariffs are certainly a tool of choice by our current president, President Trump.
Yes.
So, I think there's lots of things that we should talk about. First, what is a tariff? Who pays for it? Maybe second, why is it a tool of choice for Trump? And then maybe even talk about what are the long-term ramifications? Because I think there's short-term and long-term when we talk about what tariffs are or aren't. So why don't we start there, Anna? When you think tariffs or somebody asks you about them, good, bad, indifferent, where do you start?
Sure. I think one of the things that's important to note is that we've had tariffs pretty much since the start of the United States. Like, they're not a new thing. And although you don't hear very much about it in the news unless it's an election year and they're campaigning on it or they've done something drastic, you really don't think very much about it. We get a price for an item and we pay whatever that price is. And we know that we might check, is it made in America or is it made in China for certain things? But you don't really think about how does this price get here, and how do the goods that we import into the country get here? What does it cost to import them? And a tariff is basically a tax that the country that is importing or exporting goods, it's usually importing. The country that's importing goods is saying, hey, in order for us to accept your goods in our country and sell them here, we're going to tax you to bring those products here. So when Trump says, I'm going to raise tariffs or start tariffs on a certain country, it means that the items that we're buying in our country are going to be taxed. And that does a couple of things. One is it helps us create some income for the country to pay for all the things that we spend money on, good, bad, or different. And by taking in some revenue externally generated, it allows countries, if they choose, to tax their citizens less. So it's basically a tax, and it's applied by most countries. Most countries have some type of tariffs to allow imports. Now, when you have a global era, as we have for quite some time, I can't tell you the year that it kind of started, but globalism became greater and greater after Bretton Woods, after World War II, and then even greater after the GFC, where the globe was in a massive recession, right? And so every country and different parts of the world have different resources that other parts of the world want. And so we became more of a globalist world where, we import things from other countries. Germany imports oil and gas from Russia. We import a lot of pharmaceuticals and pharmaceutical components and semiconductors and chips and things like that from China. And all these other countries take things from us as well. And so as you became more globalized, more and more countries were trying to cooperate and say, you scratch my back, I'll scratch yours. We each had tariffs on each other, but they were considered kind of equal. And this is really, really important because people don't realize how a big shift in tariffs could really upend the markets and upend our cost for things. But essentially, we said, as a globalized world, we're going to be friendly with our other countries, and we're going to send you the things we make, and we're going to accept the things you make. And what has happened in the past multiple times is that when a country or countries decide we don't want to play ball anymore, or we want more of the pie, they raise tariffs, and that's those taxes. And what can happen if you're not very, very careful is that you can spark a trade war. And that is essentially when different countries have different balances. One country owes the country more than they bring in. It's called a trade deficit. And if you create big trade deficits, then that is not a good thing. You don't feel like you're being treated as fairly as these other countries are. And that's Trump's argument that, hey, we have big trade deficits. We're paying more in tariffs than you're paying to us. And therefore, we want to balance those. We want to balance those trade lines. We want everything to be fair. And Trump is arguing things are not fair. We're not getting as a good end of the bargain with our tariffs as other countries like China, Mexico, Canada, parts of the EU, what have you, are getting. And so he says it's time for us to level the playing field. We're going to charge you a little bit more, or we want you to relax some of the tariffs you have so that we can have greater trade balances. So that's kind of where we are and what tariffs are. The question is, are the tariffs that Trump wants to put in too big, too fast, too soon? Will they create a level of anger of our trading partners that they will say, we're not going to trade with you, or we're going to go tit for tat. You raise tariffs on us, we're going to raise tariffs on you. And the fear is we're going to create some trade wars. And trade wars, if left too long, can create a lot of tension, and they can escalate into other types of wars. So the big fear is, will this escalate into a hot war, let's say like with China, for example? So that's basically what it is. What else do you have to add?
Well, I think there's a couple of things we need to have about tariffs when I think about all the questions and comments I get. One of the misconceptions I think a lot of people have is, let's just talk about China, for example.
Yeah.
They think that China is actually paying the tariff. That is incorrect. Let's call it, let's be very specific. Let's talk about Chinese a car. And let's say there's a 10% tariff on that car. Let's say that car costs 20 grand. So what actually happens is China doesn't pay the extra $2,000. If I am an importer who wants to import that Chinese car at $20,000, I, as a U.S. company in this example, I have to pay 22 grand. 20 grand goes to China in this example, and 2 grand goes to the federal government or whoever collects the tariff, the Treasury or whoever does that. I have no idea. So the first thing that most people get wrong is it's not China paying the $2,000 in this example. It is a U.S. company in this case who imports the car. Now, if you follow that forward, the next question is, who really pays for it? Because what we've just done is we've taken a car that used to cost 20 grand, now costs 22 grand. And that importer, who obviously is importing it because they want to sell it, they have a choice. Do they raise the price $2,000? They pass it on to the end consumer. Do they pass on $1,000 and eat $1,000, i.e. sacrifice margin? Do they absorb the entire $2,000? These are all decisions that will be made. So the first thing I think a lot of people get wrong that really don't understand this is China's not paying the 2 grand.
Here's the thing that I'm not sure about, because again, I'm not an expert on tariffs. I've never tracked, I understand what they are at a high level, but I've never done any research like I do on so many other areas to go, let's see when a tariff comes in, how much goes to the companies or the company pays and how much goes into the country's coffers. And what I do know is that I believe you're right in terms of the companies are having to pay more to get, especially if it's parts or components that go into what it is that they're producing. they're having to pay more on that. But I know a certain percentage of it does go into the US government's pockets, because
sure.
part of the argument is we need to raise, $500 million in tariff money that goes to the United States that we keep, that will offset some of the tax cuts we're providing to our citizens. So there is some mechanism, although I don't know what it is, that says certain tariffs, the costs are the profits come directly to the US government.
Sure.
And other tariffs go to, the companies or are paid by the companies that are getting the components. It might be, Michael, and again, I don't know the details. This is just theoretical, but when we are trading oil and gas, although, it's coming through pipelines and companies, I think that the energy trade probably goes directly into the US government's pockets more so than other components are.
Sure.
So I'm just not sure how that mechanism works, but I know that because countries do take and pay tariffs for their imports and exports, they do create government deficits toward each other. I owe you, you owe me.
Yeah.
So there's a piece of it that is absorbed or taken in by the governments themselves. And then there's a portion that's paid by the companies. And then to your point, the second piece of that is historically, what are the facts about whether or not companies raise prices, which creates inflation for the consumer? And it's interesting. I mean, common sense tells us if a company's costs are more, they're going to charge you more so that they continue to make a profit. That's just reality of any business 101. If your costs go up and you can't get by and be profitable without raising prices, then you're going to go under. You just can't absorb it all. So, part of the argument for those that are for tariffs is historically, and I've heard economists talk about this. I just don't remember the details and the numbers to talk, to give you the details. But I've heard economists like Lafler. Lafler has been, an economic advisor to Art Lafler, to multiple presidents on both sides of the aisle, Republican and Democrat. And he has said that historically, the costs of raising tariffs generally do not cause significant price inflation. And that tariffs, this was something that I didn't know either until recently, that tariffs are usually very selective. They're usually not across the board, like 25% of everything that comes from China is going to be tariffed. Usually, you've got the questions, are you going to have tariffs on energy that's coming in? Usually there's a select group of products that have tariffs, and then other products don't, or they're minimal. And so, for example, cars, I recently learned, where have I been living under a rock, right? That China, that we have 100% tariff on electronic vehicles coming out of China. Why is that? Because we want electric vehicles produced in the United States to create jobs. And so that we're propping up Ford and Tesla, for example. So by tariffing 100%, a vehicle, and this is a stat that I just recently read, that costs $30,000 for a particular EV in China, maybe by a Chinese company. If we were to want that car, it would cost us 60 grand to buy that car, because the consumer is paying that 100% tariff, and then you're paying 60 grand. Well, if Tesla and Ford can make it for 40 or 50, you'll buy it for 40 or 50. So tariffs are not across the board on all products. And the argument that guys like Lafler have said is that most products coming in do not have significant impact on the bottom line prices that consumers pay, or there are alternatives for things that we can buy that are American made that will allow us to shift from, okay, I'm not going to buy I'm making this up, the Samsung. I have a Galaxy, right? I'm going to buy the Apple that's made here in the United States. Now, they have parts that they get from China, but the argument has been that historically, the specific things, the goods that have tariffs, generally, those companies are so profitable already that they just take a little less profits and pass very little of it to the consumer in terms of an amount that makes a big impact on their pocketbook. Now, what I've heard on the other side is that these tariffs that Trump is proposing today will cost an average consumer about $1,200 more a year across all the things that are going to be tariffed. I haven't dug into the numbers to see if I agree or if that's right, but common sense, to your point, tells me if a company's going to pay more, they're going to attempt to maintain their profit margins, and therefore they're going to raise the costs on consumers to some extent. So I do think that they are generally somewhat inflationary, but I will tell you that economists that I respect have completely different data supporting their argument that they are or that they are not. And so it's hard as a general a general citizen to say, how is this as bad as the left-wing media is saying? Is it as good as the right wing is saying? And I have become pretty moderate and pretty skeptical. And I read articles from left-leaning, right-leaning, central-leaning, pure economic-leaning. And I tend to only really digest the economic data coming from economists that are saying, we know the answer and here's why, because they tend to be less biased. And so I'm not seriously worried about tariffs, to be honest with you. However, what I am worried about is, are we alienating our trading partners to the extent that the tariffs that they come back tit for tat are far greater than the tariffs we've seen in the past, and therefore create, one, more inflation than they have in the past, whether they did or not, but two, so much more tension with the United States than we already have, especially with the BRICS nations, Michael. And I know we could take this a whole, another way, but at a very high level, there are a lot of countries that have said the US has been the dominant financial power, and they're trying to tell us what we can and can't do with our own currency, our own imports and exports. And after Russia went after Ukraine, we put in monetary sanctions against Russia and basically took their US treasuries, the reserves that they had in treasuries. And that a lot of global countries came back and said the US has now weaponized the treasury. They have weaponized the dollar. And therefore, we have to start thinking about moving away from US dominance ruling our own economies. And I think that that's already been happening significantly with the BRICS countries, with more and more joining and trading in something other than the US dollar and holding less US dollar reserves. I do worry that if Trump goes too hard, too fast, even if he uses it as just a negotiation ploy and he doesn't really intend to be 25% tariffs, for example, on Mexico and Canada and 10% on China, but he's just starting there to get them to react, as it looks like he may be doing. The question is it too much that it's going to create more desire to move away from the US dollar and therefore hurt us more than the money that we could make by raising tariffs in order to be more fair? And truly, that remains to be seen. Whether you like Trump or don't like Trump, that's the bigger risk to me of these higher tariffs, is what does it do to us long term? And does it make our trading partners less desired to continue to work with us, both with trade and with reserves in the U.S. Treasury?
Yeah, kind of putting a pin in tariffs. We'll move on to equities in a minute. But when I think about tariffs today, I think there's a couple of things that are important to me. One is it's going to make the Fed's job harder.
Yeah.
Right. I think there's just a lot more variables or balls in the air that they're going to have to estimate or guess or whatnot. Generally speaking, in the short term, tariffs are without question inflationary. Tariffs can come and go. We could start. I mean, there's so many variables. So the first thing I think about tariffs is Jerome Powell and his cronies are not cutting rates anytime soon. There was current expectation, I think, a month ago that there would be 4 cuts. I'm sticking with my call, 0. Right? I don't know how the Fed can cut in this environment with all of these variables, at least certainly in the next 6 months, right? It's just
what I think could change that, though, Michael, and this is why it is hard to know what's going to happen. I mean, even the experts are like, we haven't ever been exactly in this situation before, so we really don't know. But if you look at what happened to the stock market the day after Trump, Saturday, Trump said, or Friday, late in the day, on Saturday, these tariffs are coming, and people were like, oh crap, he's actually doing it. And the markets, the pre-markets were significantly down. Monday, it's like market starts to tank. And then all of a sudden it's like, oh, we've created a plan. We've worked something out. We've negotiated, and then the markets go back up. I argue that the markets, and I know we're going to talk about this in a little bit, are very in bubble territory, and very small things that create uncertainty spook the markets to a point where if you've got enough things that create uncertainty that spook the markets at one time, you really could end up with a major market correction. And that's something like a 30%, 20 to 30% drop in equities. And if tariffs go through and companies are afraid that, one, the consumer is tapped out, they are pulling back on discretionary. And I saw an article this weekend. I didn't, dive deep into researching it yet. But if it's accurate, that now the middle class has pulled back significantly on discretionary spending. So we talked last week about, 70% living check to check, how it's different or not different from in the past. But as consumers seem to be more stretched, they are starting to pull back on discretionary spending other than holiday spending, which they always, charge up. And if that starts to happen and these companies are worried that I can't raise prices, like drug companies, for example, pharmaceutical companies, tech companies that rely on things from China in particular, if they're worried that they can't pass on those price increases to the consumer, it worries them about their ability to create profits in the next couple of years. And that's why these, investors are going, wait a second, tariffs are bad. And they're pulling out of the market, and the market values of these companies are falling, which means they're not as profitable, which means if there is a domino and if the markets really react negatively and a trade war seems to be escalating, it's really bad for corporate profits. And that could spark that market meltdown. If we have a market meltdown and companies start to lay off, Powell will say, okay, because guess what? When they have a choice, are we going to save the system, or are we going to allow a little more inflation? What are they going to choose? They're going to save the system. And so they're going to cut interest rates drastically if that happens to try to calm the markets. The Fed put will be back in play, Michael, and they will rescue the system. And that means that they will drastically cut rates. They'll say unemployment's now ticking up. We have all these layoffs. And now the balance of risk has switched, to recession and unemployment and market meltdowns more so than inflation, which is on the path down. But right now we've got to save the system and unemployment and the markets. They're not going to say the markets. They're going to say, the risks to unemployment. And I think that could happen this year. I really do. 50-50 toss up. Who knows? Wow. But if there is a market meltdown and a trade war, they will cut rates drastically, but it will be short-lived, in my opinion. And therefore, when they do it, you go on a buying spree, you go on a refinancing spree, you lock your interest rates as long as, 10 years if you can, at those low rates, because after that, guess what? More government spending, because QE is not only the Fed cutting rates, but it's the government then going, we got to save the system. We'll cut expenses in all these other areas, but we're going to have to pump money into the system, and we're going to go right back to QE.
Yeah.
What happens? I don't know, because I don't know what's going to happen with tariffs, how bad it could be, and how hard it will impact the markets. But it will impact the markets, no doubt in my mind.
Yeah, well, we'll get to that in a minute, because calling for a 50-50 chance of a 30% crash this year is going to be interesting. My closing thought on tariffs is short-term pain. They are inflationary. We've gotten reports from the Fed. We've gotten reports, about what a car would cost coming from Canada. There's all examples about at least short-term inflation. Long-term, tariffs have been historically a revenue generator. In fact, there was a time in the U.S. history where we didn't have income tax, and tariffs were the only way we kind of funded the government. Yeah. It's not crazy talk. It has happened before. So again, one of the big things that I think we got to do is we got to bend the curve on all this, this crazy debt that we're having. So more revenue, not a bad thing. And then lastly, on tariffs, if you can look out long term, they are generally positive for, let's talk pharmaceuticals, right? Today we produce nearly nothing. If we want to become the pharmaceutical hotbed in 4 or 5 years, we've got to create that 100% tariff example you had on EVs from China. So
Yeah.
it gives our companies a chance to compete. So
Yes.
tariffs closed. Now let's go to the stock market.
Yeah.
I think there's a lot of people, and Paul Tudor Jones, I read an article just the other day talking about, Trump's term in office is a lot more, perilous because, again, the stock market is priced for perfection. It's had back-to-back years with 20% growth. That does not happen very often.
Right.
And, lots of people look at the market and looked at this weekend as an example of just how crazy it could get on the downside, right? The momentum. And the futures market, when it opened up, had the stock market down like 600 or 700 points on Sunday, right? Sunday evening. So it just shows you that there's a lot of people ready to pull the exit button. So, I think there's, lots of things could go wrong.
Mm-hmm.
And, a 30% crash in the stock market is not unheard of. In fact, if you go back to 2022, I think it was 24% year to year, and it might have even been more to that, kind of peaked the bottom. So why don't you talk about, I know you did a post on Facebook talking about the market being richly valued and what might be something to look at if you're nervous.
Sure. And I'll say this, I think it's important, anytime you talk about equities, because you could be accused by the SEC of giving investment advice without being an investment advisor, right? I'm a former private banker. So I started my career about 28 years ago now, I think, at Bank of America in the private bank. And so I had some of my securities licenses. And so I do have some background in equities, even though I've been primarily a real estate investor. Since the GFC, I've been very little in equity. So I will admit that up front. And so my opinion might be somewhat biased because I've lived through the GFC and I've seen the ability of
we have scars.
I've seen and experienced on my own. Even during the GFC, I worked for AIG and we worked with the wealthiest of the wealthiest. We were in a small department that worked on hedge fund wrapped insurance. So essentially we created policies for banks, institutions, companies, and ultra high net worth individuals to allow them to invest in private placement type of investments, in addition to retail stocks and mutual funds and things of that nature. So, and I was blindsided by the GFC and wiped out. About 75 to 80% of my 401k was wiped out in the GFC. And it never came back. So that has happened in the past and it can happen again. And so with that reality, I will say this, I missed a lot of upside in the last couple of years in the stock market because I felt like we were already in asset bubble territory in the markets. But when you have a section of the economy who thinks, you cannot lose, America cannot lose, we're going to continue to do well, everything's great. Just like people said in 2007, everything's great, the economy's booming, we're never going to, go back. And then in 2008, we had a recession. 2009, it was even worse. So the reality is at the top of any cycle, economic cycle, there's something called irrational exuberance. And it's people are so excited. They just think that they can't lose. And so they continue to invest, but they often invest out of that exuberance and excitement without really looking at the fundamentals of their investment. And when that happens at the top of cycles for many different reasons, people invest on FOMO. It's the fear of missing out. And they're looking at where can I put my money that my friend and my next door neighbor and my shoe shiner are doing well. They're telling me they're investing there, so I'm investing there. And so I believe that we are at the peak of a market that is based upon irrational exuberance and FOMO and not the fundamentals of investing. And just a couple of stats to kind of back that up. There's an important metric that a lot of hedge fund managers and economists look at called the CAPE multiple. And in the S&P 500, it's 37 times. It's the price that people are paying for stocks is 37 times the CAPE multiple. So it's a 2.3 standard deviation event, which is big. Okay. 2.3 points above where normal pricing is in a stable market. The only time that the stock market has ever been this expensive, meaning the price per share that you are paying versus the earnings of the companies today, is 1929, which
No.
I know, we're only 50.
That's not a good year, folks. That's not a good year.
It's right
That's not a
before
good
the Great Depression, right? And 1999 before the dot-com bust. And so
Ouch.
it's telling you that historically, we flat out are significantly overpriced. People are buying stock at prices that do not reflect a future earnings potential with any bumps in the road. It's like price to perfection, like you said. Okay. The other thing is that the PE ratios today, in order for the price that people are paying are assuming about a 20% increase annualized return over the next 5 years. So they're paying a price to earnings basically means I'm buying the future earnings and future cash flow and future growth of this company. And so I think that this company is going to do so well that they're going to make 20% annualized returns for the next 5 years. The question is, we already are in an economy that is not working well for the average person, an economy that is recession-like, cost of living up 25% in 4 years plus, and people are pulling back on discretionary spending. So the question is, what's the likelihood that with inflation, higher US Treasury rates, which mean less lending, which means companies cannot just borrow to grow, which means they typically start laying off people, with significant high government debt, that they're basically saying none of that's going to matter. We're just going to keep going, and it's going to be gangbusters. And my question is that reality? And most people, common sense would tell you no, but economists on both sides of the aisle say we are way overvalued and we're in bubble territory. And when hedge fund managers, billionaire hedge fund managers that have been in the business for longer than I've been alive are telling you we are in an asset bubble and a stock market bubble, almost like has never been. I mean, 2 times in history that it's been similar. They are warning you, get out. And this is how they've made their money, right? So it's not just me saying this. It's a lot of very smart people. Ray Dalio, Jeremy Grantham, they're in their 70s and they're saying, we're in an asset bubble. And they've been saying this for 2 years, and they've been shocked at how long the irrational exuberance has gone on. A lot of it's because we had so much money given to us post-COVID that there's a lot of money on the sidelines. It's just like, we got to put our money somewhere. And there's hope, in fairness, that AI is going to create such a productivity boom, and technology is going to create a productivity boom that's ultimately going to drive down inflation and allow companies to do better, create more profits. And that's what they're banking on. But you saw things like DeepSeek come out and say, we created the same kind of AI as NVIDIA for far less money, whether that's true or not, whether they stole our technology or not. One company coming out and shocking the market, and NVIDIA went down, I think it was 17% in a day. I could be wrong, but I think it was something like that.
It was the largest drop in market cap in any single
and
day.
That was
almost 700 billion.
Company coming out and saying, we have better technology than you and we can do it cheaper, spooking the markets because the markets are so concentrated in a couple of key stocks, largely healthcare and technology and AI. So the other thing, and there's just 2 other things I want to throw out there, and then we can chat about it and add more to it. But one of the risks that I see today is that when you look at, let's just talk about discretionary, because again, with inflation, the so what of it is, can people afford to buy stuff they don't need and just the stuff they want? And largely, I would argue, and we could go back and, you could go back and listen to last week's video, but consumers are spending 25% more on the stuff they have to spend on. So they have less money to spend on discretionary, and borrowing is already kind of maxed out. And so the question is, what happens to discretionary stocks? And there's a bunch of them in the S&P. When you look at the S&P, and again, I might get the exact number slightly off, but overall discretionary stocks, companies that sells discretionary goods and services that we want but we don't need, are up 12%, about 12% over the last year. But Amazon drives most of that growth. When you take Amazon stock out and you look at the rest, they're actually negative returns, negative.
Correct.
So similarly with the S&P, when you look, and NASDAQ as well with tech, but when you look at stock market, the 20% growth, it's primarily heavily in those Mag 7 that have now dropped to kind of the Mag 5. And so if you take them out, that growth is much, much lower. It's lower than historical norms. And on an inflation adjusted basis, it's actually negative. And that's the people don't realize that these returns on an inflation adjusted basis are not as good, and then on a tax adjusted basis, as what they have been historically. But what's really dangerous, Michael, so if those companies take a hit with tariffs or with, some new company coming or any small thing that spooks the markets and surprises them, that is going to bring down a lot of the S&P, not just those couple of companies. And then the biggest thing that I worry about is really people that are retirees, because I've seen this happen. I've seen it happen in the dot-com bubble. I've seen it happen in the GFC. Historically, investors, retirees have been told and have kind of followed along these recommendations to have about 35% of their wealth in equities. Okay. Right now, today, Michael, 70% of US household wealth is invested in the stock market. And most of that is in index funds. In my grandparents' age, they would be in their 90s today if they were still alive. They invested in single stocks like, the Nifty 50 or the top 10, the GE, Coca-Cola, MCI, WorldCom, et cetera. And when those one companies went down, they would lose, but they had all these other companies that were doing well. Today, by and large, people have gone in just into index funds. They're like, let's just follow the index. But if the index funds are being held positive by the Mag 7 and by, companies like Amazon and discretionary, and anything spooks those, everybody will want to sell. And now it's not just 30% of wealth that's selling. It's everybody. Retirees especially are like, oh crap, we've got to sell. And so you have a bunch of people trying to sell, but who's going to be buying until you hit a bottom? And that can create a real issue. And what I would hate to see happen, and this is just my warning of things for people to consider, is that if 70% of your wealth is in the stock market, and it is a 2.3 standard deviation of being in an asset bubble and price to perfection, and we don't have 20% growth over the next 5 years annualized, if the market corrects, 70% of households that have wealth in the equities market could come crashing down. They could lose a lot. And the thing is, Michael, it might not ever come back because the price they paid, if they paid these top dollar prices, is so high, it could take a decade for those prices to get better. And you look at Amazon, years ago when the bubble popped, I mean, they were like worth almost nothing. Now they came back, but it took 10, 15 years for them to do so. So it's just a very dangerous overheated market because 60% of that 70% of household equities is in those index funds. And the index funds go up with the market, but they come down pretty fast when the market comes down. So I just think there's significant risk and that people should consider doing what Warren Buffett did. Okay, Warren Buffett's a smart guy. In his entire investing career, he has never had 30% of Berkshire Hathaway's money in cash. And when he did an investor meeting last year, they asked, why are you selling Apple? Are you worried about Apple? And he said, no, Apple's a great company, but it's way overpriced. So we're taking our gains and we're going to sit on cash until we find an opportunity to buy things at prices that make sense. So when Warren Buffett sells and captures his gains and says, this is price to perfection, let's take our profits. We'll sit on cash. Yeah. We're being paid to sit on that cash in money market accounts and in CDs. When the markets do fall, what he's saying is when prices make sense again, we're going to go buy a bunch more Apple. But we're taking our gains. We're sitting on cash. We're being paid to hold cash. And when things correct and go on sell, we believe in the markets and we'll go back in then. And that's what I think people need to really, really think about. What is the smart money doing? The smart money is capturing their gains, and they're suggesting a flat decade. I think we should listen to them.
Yeah, I think Warren Buffett is an excellent example because he's been trading for all of our adult lives, and he's only gone to cash or heavy cash a couple of times. Yeah. And just like the other times he went to cash, he was made fun of because, again, when you got the portfolio size of Warren Buffett, you can't go to cash quickly.
Yeah.
Right. It takes you weeks, months, and quarters to kind of reposition yourself. And, by the way, historically, he is early.
Yes.
But he's also happy to wait and be paid.
And that's so key, Michael, because people think there are way more retail investors, individuals like us, in the markets over the last couple of years than have been historically. Mm-hmm. Historically, the wealthiest of the wealthy big institutions, companies, very wealthy individuals were invested in the stock market. And even then they only had the 30 to 35% in. But what's happened is post-COVID, with people having money, they're like, oh, my friend's making money on these meme stocks and Blockbuster and AMC and, NFTs and all this stuff. So they're starting to speculate and putting a lot more. So there's a lot more investors who really don't understand the stock market. And I can say that as a former private banker, even wealthy individuals don't really understand the stock market. They've just kind of trusted their advisors to put them in the right things. They don't have time to look at what they're doing. So these investors who are like, Anna is an idiot. She could have made all this money being invested in the last 2 years. We made 20% returns, right? Or Warren Buffett's an idiot. He sold too soon. The reality is we never know when that bubble's going to pop. And until it does, the FOMO, animal spirits, irrational exuberance continues to float. And those that don't really understand the economy and the markets just think, I'm a rock star now. I made all this money. And anyone who doesn't, they're too old, they're too conservative. They don't understand the economy. That's why we call the big guys like Warren Buffett the smart money. They're older, they've been around the block, they understand these dynamics of what things can make the bubble pop and the dynamics of what things drive corporate profits versus what are the headwinds that are going to stop those corporate profits and reverse things and cause a correction of some sort. And so it's important for us not to get too greedy and not to get too prideful and think because we had a win for a couple of years, we now know more than, the guys. It's generally the guys that are in their 70s to 90s because there weren't very many women in the investment space at that point. But I listen to the old guys because there's wisdom there. They've been around the block. They're smarter than me. They know more than me. They've done well. They've made billions of dollars for their investors. We better watch what they're doing, Michael, and take some warning signs. And again, I'm not saying get out of the markets completely, but I'm saying if you've got 70% of your wealth in a market that the smart money says is overvalued, you better start considering whether it's time to take some of those gains, not get greedy. And if you take the gains, you're doing it at the lowest capital gains taxes just about in history. So you can take the gains, you can invest in some other things that give you some tax benefits, park your money, be paid to park it. And then when the equity markets do fall, you'll make a ton of money when you go back in and buy good companies cheap. So it's not losing by pulling the money out, but if you stay in too long, you could be wiped out and it could take you a decade to recover.
Yeah, we're going to switch to the third topic in a minute, getting healthy at 50 or above, both male and female. But I want to kind of close on this. We have seen irrational exuberance in lots of different areas. We saw it in single family homes in 2005, 6, 7. We saw I called it in multifamily in 21 and 22. Yeah, and again, it takes years for the pain to come, but the pain does come.
Yeah. And it takes years to grow out of that pain. And that's the other thing.
Well, some people will never come back.
No, absolutely. Yeah. When values fall 30% by people that held bonds or real estate just because interest rates went up, nothing that they did, nothing else, simply inflation caused interest rates to go up and therefore their values on paper are down. You don't come back from that unless it goes back to the way it was before, which means really low interest rates that create a new round of exuberance for, things like corporate commercial real estate. And then that money that's been on the sidelines drives up values for a while until it happens again. So these things go in cycles, but people don't understand how long, Lacey Hunt likes to say long and variable lags. They're long lags, but when you do hit a bottom, it usually is bad for the economy. It usually creates a recession or stagflation after, high inflation. And that generally takes 2 to 3 years to recover from a mild recession. So it's once you're past that 2 to 3 year mark before you even start the next expansion. So the question is, if you are wiped out 30%, it's not like the next month Trump's going to come in and save the day like people want to think he can. Like this is very complicated. And it's usually 2 to 3 years just to start the recovery. And then you've got, a decade before you usually recover a 30% loss.
Very, very cool. Let's get into our third topic. We both have taken on personal health journeys. Not that we didn't try all these things before, but I think both of us are having new success because maybe we're admitting that, we're just a little bit older, a little bit wiser. we have to do things different. So I know you've had some great success here recently. Why don't you just talk about, getting healthy as a young woman, only 50 years old?
I'll say it's a lot harder to do it post
Amen.
40 than it was
Amen.
before. And especially for women, this isn't to pick on men or,
No.
Victimize women, but the reality is when we go through hormonal changes, it has a
Mhm.
significant impact on weight, more so
No
than
question. No
people
question.
thought before. And so, I knew, and my friends that were, 40 and older, have already had their babies, like all of a sudden you can't take weight off. And it's like, what's happening? For me, for example, I lived a high stress life as a working mom, entrepreneur, helping my husband with his business, building the real estate stuff. I worked 70, 80 hours a week. And when you do that and you're in your 20s or your 30s, your body can keep up for the most part, right? It's not great. We need sleep, but there's a lot of studies that show that are coming out now that I wish I had known back then, that high cortisol levels will definitely make you gain weight, and lack of sleep will definitely make you gain weight. So I knew part of the reason I'm gaining weight, even though I'm trying to eat well, generally, and trying to get some physical activity. Although that I didn't work out as much as I should have in my 30s. I wanted to, I knew I needed to. I was always on the go from here to there to there to there. But a lot of sitting, and, at a desk job, and then sitting at my husband's practice and handling billing and staffing and whatever. And then at night, you're swinging a hammer or doing whatever. But we know that a lot of sitting isn't really good for us, and that can create weight gain. And then the lack of sleep and the cortisol. So those things had an impact for sure. But the old science was basically calories in, calories out. So, you go to a doctor and you're like, why can't I lose weight, or a trainer? And they're like, just cut your calories down to 12 or 1400. And that's, was the recommendation for women. And you'll lose weight. Well, I wasn't losing weight. And no matter what I did, I couldn't lose weight. I lived low carb living, which was really important to regulate blood sugar, because insulin can drive and does drive a lot of weight, and your reaction to sugars and to carbs will cause you to need more insulin. It creates weight gain over time. And so guys like Dr. Atkins came out when I was in my young 20s, and it's like, you need to eat less carbs and you need to prioritize protein. And so I did that, and I was able to keep my weight off successfully until I hit kind of my mid 30s, late 30s. And that wasn't working anymore. So then I did keto, right? And doctors and scientists are like, hey, you do keto, you cut out your sugars, very similar to the low carb, and your body's going to be fueled on ketones, and you'll shed a bunch of fat. And that worked for me for a while. And then I hit, 40s and quit working, keeping my calories low, trying to exercising more, moving more, keeping my carbs low. And I couldn't lose the weight, Michael. It was like, none of these things are working. What is it? I've lowered my stress. I bought a sauna. I made sure I slept and prioritized that. I took healthy supplements that are try to, boost your metabolism, like chromium, picolinate, and all that. And Michael, I could not lose weight. And it's so frustrating, especially for women. Well, now there's new studies. And here's the thing, the science keeps evolving, and we need to be lifelong learners and figure out what works for us and what doesn't. And so I saw a couple of doctors and I read some books. And now they're saying, studies on women, when it comes to weight loss studies, like all these calories in, calories out or whatever, it's very few women that actually participate in the studies. It's mostly young men that are paid to participate in the studies, but only 0.3% of global health studies, 0.3%, are targeted to women over 40. And all women, it's like 3%. 3% of health studies target women. And so now they're finding that as women's hormones change, 40 and above especially, but even more so mid 40s and 50s, and you enter perimenopause and then menopause when you're usually about 50 to 51 is when that happens. You no longer produce progesterone and estrogen. And for men, it's testosterone. When you don't produce estrogen and progesterone, your insulin cannot work, even if you're doing all the right healthy things, low carb, low calorie, et cetera. So it's just as bad as cortisol leads to fat. Well, why do 50-year-old women gain a bunch of weight around the belly? It's because they don't have progesterone and estrogen to get that insulin working. And so with all that said, I experienced all of that and I couldn't figure it out. So I went to a doctor again. And a lot of the doctors are still just saying, oh, I don't believe you. They're not telling you this, but
Oh,
menopause is just part of life. Like you're fine. Just eat less, work out more. Well, that doesn't work. And the studies are showing that, but there's so few studies, they're pretty recent on women my age, that it hasn't really trickled through to the medical community. So I went to a doctor. I got on hormonal supplements for a couple of years, and then they stopped working, and I was still gaining weight rapidly. And I called a doctor and I said, I'm interested in what else can help me. I've heard about weight loss drugs. I've been very skeptical. I don't want to go on medications. However, this is where I am. And, I had an obesity doctor say, Anna, you've done all the right things. I gave her 10 years of MyFitnessPal calories, all these things. And I knew my glucose was high. So I started using a glucose monitor. I was pricking my finger, looking at my blood sugars rising, which means I've become pre-diabetic and insulin resistant, despite all the things to counter that. And she recommended a drug called Mounjaro. It's also known as Zepbound. It's by Eli Lilly, one of the big, drug companies whose stock's gone crazy. And what it does, yes, it slows digestion and makes you a little less hungry. But the primary mechanism is it just makes your pancreas create enough insulin so that you're not insulin resistant. And just by going on that shot, which I'm proud to say I did it, I took control of my health. I did the research and the risks were very, very minimal if you go with the actual branded study drug. And I started taking the shot, and I didn't change my diet. I didn't change my exercise, but my body was able to produce enough insulin. And that alone allowed me to lose a little over almost 64 pounds in about 8 months. And
64 pounds in 8 months
pounds in 8
from
months.
one shot.
From one shot. And again, this is a drug that has been used for diabetics to control their insulin. Instead of taking a daily insulin shot, they take a weekly shot. So it's a drug that's been studied, and it's essentially for people that have become insulin resistant. And as you get older, I hate to tell you, but 70% of the population will become insulin resistant. And once you become insulin resistant, you become pre-diabetic. And that is contributing significantly to the obesity epidemic. And you may be the 30% of the population that genetically is never going to have a problem. And for those of you, congratulations. It's amazing.
Congrats.
But for the rest of us, 70% will become pre-diabetic, usually by age 40. And for women, it's much, much faster as you're going through that transition from 40 and above, where you're no longer in childbearing years for the most part. And so for me, it really has been a miracle drug, and it's not for everybody. It shouldn't be, I don't think it should be taken by teenagers and young women and young guys who just want to lose the vanity pounds. This is really meant for people that truly have insulin resistance. And especially if you're 40 and above, it can be life-changing. And so for me, it has been, and I'm very thankful. And the reality is too, I've had my labs done. All of my health markers are better. Kidney function, heart health, cholesterol, insulin resistance. It's a drug that has only real positive health benefits with very, very mild side effects for most, which is nausea, some upset stomach, some malaise, and your body kind of gets used to that. But, for me, I'll have to be on it forever. And that's one of the things people say, oh, you're going to have to be on this forever. But my journey has been a lifelong journey of trying to do all the right things and be healthy. And the reality is, if you don't take control of your health and your weight, once you start gaining weight at a certain level and your hormones change, it not only leads to looking heavier, but you have heart disease and kidney disease and diabetes and Alzheimer's, which is
all bad things,
type 3 diabetes. So if I have to be on one shot the rest of my life that keeps me from getting all of those things, and this drug is proven to do that, it's well worth it for me. So I've been very happy with it, but it has been a struggle my whole life. Well, it's been a struggle since I was in my, since I had kids, for sure, that just got worse over time. And so, my encouragement to people is talk to your doctors, but understand that doctors don't necessarily keep up with all of the studies. And if they just tell you eat less, work out more, and you've already been doing that and it's not working, look into some doctors who talk about the hormonal theory of weight gain. There's a lot of new studies, and especially for women, there's some women doctors that I follow that are really on the cutting edge. I'll just throw real quick, Dr. Gabrielle Lyon, Dr. Mary Claire Haver. They really focus on women's hormonal health. starting at age 40 and above. So that's something I would encourage you women listeners, or those men who have women in your lives who are trying to get their health under control, to look into, and just take control of your health and do what you need to do. Talk to your doctors. Don't listen to all the naysayers and all the stuff out there that's just telling you all the negative. Do your research and take control of your health. So what about you, Michael?
It's really the same thing. So this year is all about getting healthy. I went ahead and did all of my lab works and all of that. So for me, it's just realizing that what I thought, or what made me healthy in my 20s and 30s doesn't work over 50.
Yeah.
My workouts in my 20s and 30, I would measure by how long it took me to get off the floor. That's how hard I worked out.
Yeah.
Now it's like, well, you know what? Just go take 15,000 steps.
Yeah.
And since I started this journey, which actually officially started December 15th, I've lost 16 pounds.
Amazing.
Just by tracking my calories, walking versus killing myself in the gym.
Yes.
And it's been fun. It's been fun.
One thing that I will share too, that I recently learned. So there is this balance, right? And for men, your testosterone starts to go down, not to the same extent that it does for women, but walking and doing it at least twice a day has been shown to be really, really important. So I was reading some studies that said 8,000 steps a day really should be the minimum for longevity, to reverse the damage done by sitting like 8 hours a day at a desk job. And you need to not do that in one session. So if you can break it up into two, like after every hour, take 2 minutes and do some walking, but break it up into two. But the other thing that they found that's really, really important, more so than fat loss, is muscle. So we cannot put on muscle as we get older the way that we did before. It takes a lot more strength training. So what they're recommending, instead of all the, not necessarily, I forget what it's called, CrossFit, but instead of, lots of reps and low weight, you really need to focus on pounding to keep your bones strong, and heavy weights, low reps, but heavy weights at least 3 to 4 times a week to maintain your muscle, leads to significant, like 10 years longer lifespan than if we're not lifting.
And healthy life.
Steps are important, but you've got to have a healthy, strong lifespan, prevent falls. And that comes from heavy lifting, not too many reps, 3 to 4 times a week. So I have added that heavy lifting and much more walking back into my routine as well. And hopefully that'll help us live healthier, longer lives.
Yes, exactly. Folks, you have to follow Anna Kelly on social media. It's Anna Mom Kelly, or you can go to AnnaKellyInvesting.com. You are amazing. Congratulations on your health journey.
Thank you so much, Michael.